Hello, this is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool. Today's Analyze Out Loud video is going to take a fundamental look at Coca-Cola. Coca-Cola is a dividend aristocrat that has increased its dividend for 56 consecutive years. What I'm going to start, as I often do, I'm going to take just a look at Coca-Cola from a standpoint of operating earnings per share going back to 1999. And as you can see, Coke has been a good grower. Average growth rate's only been 5.7%, but it's been a consistent grower. There was a down year in 1999, a down year in the Great Recession. But I want you to notice, even in the Great Recession, their earnings only dropped 3%. But for the last several years, since 2013, the company's earnings growth has actually been negative, as I'll show you here a little clearer in a moment. The next thing I want to add to this video is the company's dividend and dividend payout ratio. And actually, as I mentioned a minute ago, the dividend is really the allure of Coca-Cola. Their dividend record is significantly better than their actual operating record. You can see that their dividend has steadily increased year after year. And the average growth rate has been just under 9% a year on average, and a compound annual growth rate of 9%, 9.2 average compound annual growth rate of 9%. Now that's going back to 2001 in this particular iteration. If I increase that a little bit going back to 1999, then you can see it was 8.9 and 8.8. So Coca-Cola has been a very consistent producer or generator of dividend income. But one of the things I like to talk about FastGraphs with subscribers all the time is that I call this a tool to think with. You know, what we've drawn here with this orange line is a theoretical PE ratio of 15, which should be a good value reference for a company with these attributes. Coca-Cola offers a dividend yield of 3.6%. It's A+ rated. It has 46% debt and pretty decent growth, as I've already stated. But when I bring monthly closing stock prices onto this graph, you see something very interesting, and this is why I call this a tool to think with. I don't argue with these graphs. I try to analyze and evaluate what I'm looking at. The orange line is a theoretical fair value reference, if you will. That's what Coca-Cola, you might say, ought to be trading at in a rational market or rational world. The next thing, though, is the normal PE ratio. And that's simply a calculation of what PE ratio has been most commonly applied to the stock over the time frame. Now, for this long-term time frame, we get a normal PE of 23.9. So this blue line would be a PE ratio of 23.9. Now you can see there was a period of time during what was often called the irrational exuberant period, from 1998, 1999, etc., where it was trading up here at a PE ratio of 49.6. And it stayed above 23.9 for all this time frame up through into the late 2002. And then we had a period of time where the PE ratio was less than that, and it was less than that most of this time frame. So if I drop this to, let's say, a 15-year graph, which, by the way, includes 2.5 years of forecasting here, so it's not 15 years of history, that normal PE drops down to about 19.9. But regardless of which of those calculations you think is more relevant, the truth is that Coke has been awarded a premium valuation by the market most of the time. But once again, under the tool to think with concept, I think it's important to also recognize that if you look at Coca-Cola's price back in December of 1999, it was $32.66. It's only trading at about $10 or $11 higher than that currently. So from a standpoint of performance, when I look at the long-term performance here, a $10,000 investment in Coke on December 31st, 1998 would have only grown to $12,856 from a capital appreciation. The S&P 500 did roughly twice as well, turning $10,000 into $24,000, and the dividend income was virtually a dead heat. The $4,647 for Coke versus $4,653 for the market. So Coke held its own on a dividend, but what I want you to understand about this is the headwinds of overvaluation, which I talked about in the article, were enormous here. Even though the company's performance was decent during this time frame, even though they raised their dividend every year, the company was so highly valued back in this time frame. And if I just pick not the bottom or the top, but if I just pick a time, in this case March of 1999, where the PE was 43, going into the recession, you can see that Coke actually generated a negative annualized rate of return of minus 1.9% annualized. That's a 33% loss in total. So from a standpoint of capital depreciation, in this case, $10,000 would have shrunk to $6,656. The company did pay $1,600 in dividends, so you ended up with a net value of $8,296, but you actually had losses. And again, this is during a time when Coke's business was doing well and during a time when their dividend was doing well. But the point that I'm trying to make here, at least from my perspective, is that when you're dealing with a stock that's perpetually overvalued like Coke is, from a standpoint of trading at let's say a mid-range 20 PE ratio, when a company with these kind of characteristics ought to be trading somewhere closer to 15 or 16 times earnings, you can run into periods of time where your performance is very poor. Now, during this time frame, which goes back to 2006, Coke was trading at a PE of around 19. The blue line on this particular time frame is 19.9. But the point is their $10,000 performance was now better. They ended up almost doubling the dividend income of the S&P, and they ended up almost in a dead heat with the S&P from a capital gain. They still underperformed it modestly, but the combination of dividends plus capital gain meant that they did slightly outperform the S&P 500 over this time frame. So when you're dealing with a company with these kind of growth characteristics, valuation becomes critically important. Now, had you had the presence of mind to buy this stock when it was cheaper, and I'm going to cut 3 years off of this graph here, where Coke was actually trading at a PE ratio under 15, and look at what the performance was over this time frame, you see that the company generated 7% capital gain, paid $4,600 in dividends, a 9.5% rate of return, but they still underperformed the market because, as you recall, the S&P 500 coming out of the Great Recession, which you can still see the remnants of it here with the gray shaded area, has had some of the best performance that the S&P has ever achieved over this duration of time. But nevertheless, Coke was undervalued, and the company did generate a reasonable rate of return. The total return was 9.5%, which, in spite of whether it outperformed the market or not, is a pretty decent rate of return. But something else I'd like you to notice, as I've changed these time frames, notice that the growth rate has gotten smaller. During this time frame, coming out of the recession to current, the company's average growth of about 3.7%. If I shoot that back to the 15-year graph, it was 5.5% growth. And of course, on the long-term graph, the longest I can go, it was 5.7%. But if I scroll this back 2 or 3 years and then draw this as a 5-year graph, and I'm looking at now the last 5 years of actual results, I want you to notice that Coca-Cola's earnings growth has actually been negative. And one of the things I talked about in the written portion was the company does offer a 3.6% dividend yield. It still looks overvalued on what I'll call a normal 20 PE since 2005. It would look undervalued if you looked at this long term, but that's misleading because you have all these high valuations here that are skewing this line upward. But I don't want to get too technical here. The point I want to make is what's happened to this company. I'm going to use this time frame here. Actually, I'm going to go to the whole time frame because I want you to see this clearly. If you look at Coca-Cola from 1999 all the way up through really 2012, maybe 2013, it was paying out about half its earnings, 46 to 50% of its earnings. But then in 2014, 15, 16, and 17, their payout ratio increased to 60%, 66, 73, and 77%. Now, as I mentioned in the article, what the company has a legacy of increasing their dividend, so they continued to increase their dividend, but because the earnings were shrinking, their payout ratio actually increased. But if I look at it from a perspective of operating cash flow, which to me is more relevant to a dividend-paying stock like this, I still get a picture that kind of disturbs me. They were covering their dividend with operating cash flow, but their operating cash flow has been very weak in 2016 and 2017, to where their payout ratio of operating cash flow has actually ballooned up to 90%. And that's a bit of a red flag to me. And then, of course, I also like to, when I'm looking at dividend coverage, I also like to look at free cash flow. And I usually take the price off when I do this because I'm not really interested in using free cash flow as a valuation reference. Instead, I'm more interested in using free cash flow as is the dividend being covered? And in the case of Coca-Cola, we see periods during the Great Recession where they were not producing enough free cash flow to actually cover their dividend. And of course, they went into a negative free cash flow relative to their dividend payment in 2017. Now, having said that, this company is capable of doing that, because if I go into the financial underlying numbers or fund graphs and then just real quickly look at their cash and cash equivalents, you can see that Coke has, over $6 billion of cash on their balance sheet. Now, they did deplete that. It went from, let me shorten this time frame so you see all the numbers. It went from $8.5 billion in cash in 2016 to $6 billion. So they were obviously using some of their cash to go ahead and fund that dividend. But another way of looking at that is the company did have the resources to fund their dividend. Now, additionally to funding dividends, another area I'd like to look at here is common shares outstanding. And this really kind of disturbs me a little bit, because I don't like to see companies buying back stock when their price is overvalued. If you look since the Great Recession, Coke has reduced their share count from 4.6 billion down to 4.26 billion. And that's been only about a 1% per year reduction in share count. However, if I go back to the fast graphs here, I think the point I want to make is when I put stock price in here, the Coke was buying back their stock when their valuation was actually pretty high in 2016 and 17. And I prefer companies not do that, because I think it could lead to shareholder value. But here's the real question in my mind. With this company, even though it's been perennially, overvalued by the market, or been awarded a very high valuation by the market relative to, other companies with similar characteristics, the fact that sugary soft drinks are going out of favor, and of course Coke, as I mentioned in the article, is trying to do things to mitigate that, but the reality of it is their earnings growth has not been real good here lately. And if I go down and look at sales, and look at price to sales, their price to sales is actually a little high relative to historical norms. But again, I want you to see that their sales have actually been dropping. So am I real concerned about Coke? No, not too concerned. But I will say this, the company has not been performing up to historical norms. Forecasts going forward, analysts do expect the company to go back to an 8 or 9% growth rate. I consider those estimates a little strong. If I look at the analyst scorecard, however, and look at how accurate the analysts have been when making these estimates, I see that they really do have a pretty good record. If you look at the 1 year and the 2 year record, analysts have been pretty accurate on a 1 year. The company has met the estimates within a 10% margin of error, and the 2 year forward estimate has not been quite as good. Let's actually look at that a little closer so you know what I'm talking about. In 2015, their earnings came in 21% below what the analysts were forecasting. Analysts were forecasting $2.17. The company earned $1.91. So the company's definitely facing a new era here, and if they're able to turn their situation around, going down to the forecasting calculators here, you could have a decent rate of return, a 9 or 10% rate of return on Coke going forward, buying it at a 20.9 or roughly the 21 PE that it's currently trading at. You can see it's just slightly above that. Now, if I look at their historical normal PEs, the lowest historical PE that the company's achieved or the market has awarded them has been 19.7, and they would still generate decent rates of return with good dividend income, considering they're starting at a 3.6% yield. But the bottom line is, I don't think Coca-Cola is necessarily as great an investment as a lot of people talk about it. Everybody knows that Warren Buffett has owned it for a long time, but the reality of it is this is what Coke's record has looked like for Warren or any other investor over this time frame. Capital appreciation has been virtually non-existent. The dividend income has been decent, but that's, you can buy a treasury bond today and get 2.9%. Anyway, there's my view of Coca-Cola currently. Even though the market has corrected a little bit, I still don't consider this company a screaming bargain. It's been Chuck Hartwell saying thanks for listening.